Good morning, students. Welcome to the subject of financial management. We are dealing with unit number 3, and this is the function number 2 that we are going to start as far as the cash management is concerned, or this is the third unit that is related to management of cash. We are dealing with the second function of the cash management. As of now, we have completed up till the first function related to this particular unit, that is related to management of cash, and that was cash planning, right, in the offline sessions. Today we'll be taking up with the next important function, that is controlling of the cash flows, right. When we say that it is cash flow, it deals with two important flows that we will check out in detail as far as this particular function is concerned. So after preparing the cash budget, the financial manager has to ensure that there is no major differences between the cash inflows and outflows. So for the efficient management of cash collection and the cash payments, proper controlling system should be introduced, and the relevant factors are also to be studied. Now, as I said, when we are talking about cash flows may be in the form of cash inflows, or it may be in the form of cash outflows. So when a manager tries to see that both these things are going parallel, that means inflows are enough to meet the outflows, when he can manage and when he can control these sources, then it is said to be the cash management done, and that is what we will be seeing here in the detail here. All right, so let us check it out, how it comes out. So when we are controlling the cash inflows, adequate cash control or adequate control on the cash inflows is very important, and it is very crucial problem also before every financial manager. This problem is conducted because of the speedy receipts and speedy collection of the cash. So collection of cash, that means inflows, should be controlled with the following techniques. There are so many ways to control the inflows, that means to keep a check, close observation on the cash control or cash inflows. When we are talking about the cash inflows, it can be controlled through the collection through branch office. Suppose under this technique, what a company does is that in the regional branches, offices are permitted sometimes to collect the payments from the customer. Now these branch offices, what they do, they deposit the amount of the cash collected in the local office of the banks, and from the local banks it is transferred to the company's head office, so that in any ways what happens is the inflow is not being hampered, or it is not being hindered. So through such kind of branch offices, the collection of the cash is made possible. This is possible, this technique is better when the business of the company is spread throughout the country. That means if it is spread throughout the country, that means there are so many branch offices available, then at that time regional branch offices are given such kind of permission, so that they can collect from their local areas and then they can pass it on to the main branch. So that is said to be collection through branch office. When we move to second technique, it is establishing the collection centers. Many a times we have heard that companies or businesses is spread all throughout the country, all over the breadth and width of say the length of the country. Then at that time, amounts to be collected are small in value, right? Then the collection centers, what happens is that the collection centers are established in various parts of the country. તો બધા જુદી જુદા પાર્ટની અંદર એવા collection centers ઊભા કરવામાં આવે છે. So this technique is also known as the decentralization of collection method, or decentralized collection method. What happens here is that we can collect the small amount from different areas through these collection centers. So the basic purpose of this method is to minimize the time lag between mailing the time from the customers to the company. That means the customers go to the main branch or maybe to the main areas, and then they make the payments or make the due payments. Instead they can pay through such kind of collection centers. So decentralized collection method is again one more way to control the inflows, right? Next comes up is said to be the third way, that is quick deposit of the customer's check. Now what happens here is that to make the fast turnover, cash turnover, the checks written by the customers in favor of the company is should be deposited promptly, right? It is deposited quickly, and it can, so that it can be converted into cash. In short, there should be a kind of proper arrangement so that the quick deposit of the checks to the bank is possible. So this is again the way. Mind you, we are talking about the cash inflows here. As you can see it on the screen, it is controlling cash outflows. We are not talking just about outflows, we are talking about any type of flows. Flows can be inflows or outflows, and we have already checked out with 3 different ways to how to control the cash inflows, or how to manage the cash inflows, right? Going for the fourth one, it is known as lockbox system. Now these may be new to us because this is very popular in USA. This technique, what happens under this technique, it reduces the time involved in mailing and collection. So what happens here is, under this technique, the company rents a kind of lock from the post offices, and this serves as the company's regional bank, right? The customers of the companies are then instructed to mail their checks to these lock boxes, and the bank collects the checks from the lock boxes several times a day and deposit them into the company's account. So these makes the payments or the collection easy as far as the company is concerned. Thus it becomes in a decentralized form also, and at the branch level also it can be collected. So company is freed from rather receiving and depositing the checks. Instead, the bank takes up the responsibility on their behalf through these lock boxes, and the speedy mailing and the clearance of the check can be done. So lockbox system is kind of collect cash, is a system through which the cash can be speedily collected, because customers can mail their payments to the nearby post box, and bank opens the box and picks up the checks several times. Many times these checks are picked up and then deposited to company's account. So these are the ways through which a kind of inflows can be maintained as far as the company is concerned. Go to the next area, then comes up the next flow, that is known as controlling the outflows. Now outflows, as we know, is related to payments, right? So for adjustment timing between the inflows and outflows, what should be done? A control should be placed on the outflows of the cash. Now control of this disbursement, or maybe the distribution of the cash, helps the company in reducing the financial needs. Again, a few techniques are followed, like centralized cash payment may be there. Now what happens under this technique? Central office pays the creditor's bill. At the center only the bills are being paid. Payment is made through the center office direct to the parties, and the payment is made by the not by the branches, right? Instead, centralized cash payment is there. So whatever the payments are to be made to the different parties, each and every payment is done through centralized method, right? So that the payments are not delayed. That is one way. The next way is to avoid the early payment. What happens is, on the maturity date or maybe on the day of the payment, if the payments are made and not early, then the cash is not to be retrieved, or maybe the cash is not to be maintained, right? And easily the transactions can be taken up. Now what happens here is that payment is not made by the company before the due date, right? That means in advance the payments are not made. Why this is important, or how it helps it? Because whenever the payments are due, if the payments are made on the same way, then it can be beneficial to the company, and the payments can be done on the same due date. So no early payments are allowed. Again, there is the third way to do it, that is float. Now what happens under this system? Company issues checks, right? And necessary cash may be deposited later. But before the presentation of the check, the issued check is not encashed immediately and takes some time in clearing the process. So you get a little bit of time. This is called the payment float, or playing on a float. What happens? The company may issue the check as far as the payment is concerned. You have to give the checks, right? But the dates may be later on. The cash is not deposited. Later on, you on the maturity of the check, or maybe on the day of the it is a kind of mutual settlement between the company and the payment holder, right, that this is how the payment is to be done. You can get the check, but the cash will be received only after, or you will be able to encash only after a period of time. Such kind of adjustment is known as the payment float, or playing on a float. This is again a way of making the or controlling the cash outflows. Next comes up is said to be the accruals. Mind you, these things are available in your text, right, and you can follow the text as far as these points are concerned. So what happens here now? Current liabilities due but not yet paid, this is said to be the accruals, right. Remuneration, like remuneration to the employees, overtime payment to the employees, etc., may also be used, because these are to be paid after a fixed period in future. So remuneration, suppose to the staff for their services, is not paid immediately, but it is paid at the end of the week, or maybe at the end of the month. So such kind of payments can be made on hold, and that is what is known as the accrual way of making the payments later on to the staff related to their own dues. So this is how the cash inflows and outflows can be controlled, and this is one of the major function when we say that a company is performing the management of cash, right. Now what we are going to do is we are going to see few of the factors. As you can see it here, the factors have been mentioned, that what are those factors that determine, what are those factors which decides the flow of cash, right. Then here say operating decision. The first one in the factors deciding cash flow is operating decision. See, all day-to-day transactions, maybe cash sales, cash purchases, expenses, etc., affect the cash flow. We know that somewhere we have to make the cash payment, or somewhere we are supposed to receive the payments, right. So managerial decisions related to this, or how the profit is to be maintained, then it affects the cash flow. This is what is said to be operating decision, which is one of the important factor affecting the cash flows. The next comes up is sales policy. See, the sales policy of the company may be whether it is to be done in cash or in credit. If it is on the cash basis, then definitely the cash flow would be regular and fast, and on credit you may have the delayed payments. The third important factor is financial decisions. What happens at times is managerial decisions regarding the finance affects the cash flow. Say suppose the dividends are to be paid, then these are the liability of the say company, and that is to be paid. So if the company decides that they are going to pay the dividends, then the cash flow, or the cash inflows, or maybe the outflows, are to be managed like that, so that you can pay off the dividends to the beneficiaries. Next comes up is capital expenditure. For example, there is a purchase of new machinery, there is expansion of the plant, that affects the cash flow. How it affects? That means at times you have to make the payments related to the machines that you have bought. You are extending the plant, then you are making some kind of investment, maybe you are investing in some kind of securities, then you need more cash flow, right. Next factor is inventory decision. Maintaining different types of levels of inventory affects the decision, right. Changes in the investment amount may in the inventory may increase or decrease upon this decision. So this is again the determining factor. Next comes up is credit policy. That depends on a company, that whether there is liberal policy or there is strict policy. If there is liberal credit policy, then it decreases the cash flow, right. And if there is strict credit policy, what happens is you can collect the cash speedily, and you can maintain the outflows very easily. Next comes up is suppliers credit. What happens is it depends on the suppliers credit policy. If the long term credit facility is available from the suppliers of the goods, it makes the company's position easy. It decreases the speed of cash flow, right. And reduction in the cash credit accelerates the cash outflows. That means if the supplier says that no, this we will follow the credit policy, which is very strict, that means as soon as the raw materials are being bought, the cash payment has to be done. So that fastens the cash outflows then, right. The next decision comes up is said to be decision regarding investment. Now if the surplus is invested, it affects the outflows of the cash, right? If there is decision regarding some kind of investment, and if there is extra cash or surplus cash lying in the company, then naturally it will be invested and it affects the outflows of the cash. It will definitely affect the outflow, because then the restriction would be there on the cash and the liquidity may decrease. Next comes up is tax on profit. Now taxes are paid in cash always, so taxes have a significant effect. If the amount of tax or percentage of tax increases, then definitely it will have the vice versa effect on the profit, right? So if the taxes are high, then you have to make the payments, and accordingly profit will decrease, and if the taxes are low, the profit may increase. So there is a kind of counter effect on the of the tax on the profits. Next comes up is capital income. What happens many a times, that income received in the form of capital affects the inflows of the cash. Here the example has been given, that is that there is a sale of old assets, right? Then of course when you are making the sales of the old asset, then in return you are going to arrange for the cash inflows. That means it's a way of getting the cash, and that may increase the cash or liquidity of the company. So again that affects the cash flows. Next comes up is acquisition of additional capital. This acquisition of additional capital or maybe fund that may be borrowed, say long term loans have to be have an impact, that you are going to get the loans from outside, then of course you have to get it paid also, so that may affect the cash outflow. Next comes up is the seasonal type of business. What happens in a seasonal type of business, that there is receipt of cash will be in a particular season only, and while in certain expenses are such which are to be paid throughout the year, you cannot make the seasonal payment. So this affects the, or this increases or decreases the cash flows automatically. Next comes up is financial expenses. Financial expenses are to be paid when they are due, definitely, like interest, dividend, etc. So they are to be paid within that time limit, and you cannot adjust those with the cash inflows. So you have to make the arrangement for such kind of financial expenses beforehand. Next comes up is increase in the general price level. Supposingly what happens is the price may increase, right? Then additional cash is required to meet the increased prices of say raw materials. Maybe there is increase in the wages rate, or there is increase in the operating expenses. Then this kind of expenses will lead to more amount of cash to be held on hand so as to meet the liabilities, and this affects the cash flow. Next is there may be any contingent or emergency requirement, right? Definitely it affects the flow. If there is, God forbids, there is any kind of accident or maybe there is kind of any disaster happening in the industry or company, then at that time you may need a lot more much amount of fund to overcome this contingency. So contingency requirement may be affecting the cash flows. 16th one is special operations. Certain special operations may also affect the cash outflow. Like you are say advertising the new product, you are launching the new product, maybe research and development programs have been undertaken, you are say innovating the product, or you are coming up with a totally innovative product in the market, then these may require so many types of expenses, and these may be the special operations which may be affecting the cash outflows. Next is other factors. They may be considered as miscellaneous, maybe the trade cycle, or maybe the economic position of the country, like it may be depression, inflation, poor cash planning may be there, cash controlling, what is the interest rate of the capital market, in the capital market rather. There may be say kind of ineffective purchases and sales policies. All these may affect the cash inflows and outflows of the cash within the unit. So what we have to conclude here is that whenever there is a kind of cash management being done, then we can say that cash management cannot be done without the determining of the cash flows, and that is why controlling of the cash flows, which includes two types of cash flows, one is considered to be cash inflows and the other one are said to be the cash outflows. These may affect the company, and this is very important function of the cash management. So we are ending up with this second important say function, right? Next comes up, as you can see here, it is the maintenance of optimum level of cash balance. There can be see, to maintain, now if we have seen that cash inflows and outflows are to be managed properly, then how that can be managed, then there is a way to do it, and through that we can make the cash balance. So it is the primary functions of the managers to see that the condition of the liquidity remains strong, so that the payments are made in time, right, and the reputation of the company can be managed. So cash balance is required for purchasing, as we know, the raw materials, for paying the salaries, wages, dividends, taxes, even for smooth running of the businesses. So if the cash is kept on hand, then liquidity is at danger, and it becomes difficult to make the payments then, right? If less cash is with the company, so liquidity is endangered, and that may create the problem. And then what happens, the next situation is, and if the cash is kept excessively, that more amount of cash is kept, then the cash remains idle, and that is also not the correct condition for the business, which reduces the profitability opportunity of the business. So what is to be done then? Then here the work of this particular function comes up. Then this function works out here, rather, that is, we have to maintain the optimum level of cash balance, and that is what is said to be the ideal level, which is required to be determined by the managers, right? Many methods and many models can be used, and with that kind of say you can make a trade-off, you can make a balance between the different costs, and you can find out the cash optimum cash level for the different businesses. So these level may not be similar for all the types of businesses, બધા business માટે આ operating જે optimum level of cash balance છે બધું બધા માટે સરખું હોય એવું જરૂરી નથી. તો દરેક બિઝનેસ માટે પોતપોતાનું optimum level જો ફિક્સ કરવામાં આવે તો cash balance or cash can be maintained, not in the surplus form, not in the say deficient form. Instead the optimum level can be managed, right? A very important and model which is used maximum by the business is said to be Baumel's model. Here what happens is that trading cost and or transaction cost and opportunity cost are being traded off, or there is a kind of say what do we say is there is an interaction between these two costs, right, and the interaction point is considered to be the optimum cash. Now what is this trading cost? This cost is also known as the conversion cost, right? What happens here, this cost occurs when the marketable securities are sold and converted into cash. When you sell off the marketable securities and you try to convert them into cash, this transaction cost arises, right? So whenever securities are converted into cash, if the company maintains small balance of the cash, it has to sell the marketable securities every now and then, because the cash is not enough with the company to meet the liability, right? Then this is said to be the transaction cost occurring, and there is one more cost, that is opportunity cost. When this occurs, now if company holds the large cash amount for the transaction purpose, and the potential profit could have not been earned by the company on the investment of the idle cash which is left out, you are not taking the opportunity of that, it means the potential profit is being foregone or on holding the surplus cash. So whatever otherwise you would have used for the opportunity, that cash you are not using, instead you are trying to keep it for any other cost that may be occurring. So the company would have earned the investment otherwise on the idle balance that is being otherwise used, and this opportunity cost is known as the cost of holding, right? So there is a graph that has been given in your text, in which you can find out that there is opportunity cost which has a graph growing towards the that has been shown in the chart, and there is one more line exhibiting the transaction cost, right? When you try to find out an equilibrium or try to find out the balance between these two costs, it is considered, that area or that level is considered to be optimum cash balance level, and through this the balance that is enough for the company to run its business is being maintained. So in short, what happens through this method or this function is that we are trying to create such a kind of cash balance in the company in which you are not having the short of say cash. On the other hand, we are not having the surplus, or maybe the opportunity cost is not to be foregone, and such a kind of optimum level is to be maintained, so that enough fund is there with the company. So that is considered to be the third function. Now the fourth one comes up is in the form of investing the surplus cash, right? That means we all know that most of the businesses need the cash, not only to get the businesses buying or selling as stated, but also they need this for unstated period to meet maybe some kind of contingencies or emergencies, right? Then at that time they need the surplus amount to be kept, and there are advantages of having the ample cash also, and for foregoing the investment profits also. So even though the finance manager of the company shall decide the amount of surplus cash available and its investment, in investing the surplus fund, the following points are to be kept in mind. Then what happens is, if you have a surplus amount, then they have to be invested, so that you are not keeping any idle cost. But while investing also, few things are kept in mind, like liquidity, security, maybe the returns and the maturity time period. If these things are kept in mind, only then the investment becomes fruitful for the manager, and moreover you can meet the requirement of the cash very easily then. That is why most of the businesses need cash, not only to get the businesses of the buying and selling as stated, but even for meeting the contingencies. So that much amount is kept aside, and then the surplus amount is invested in the profitable ventures, right? But you have to also keep the liquidity, the security, how far it is marketable, the securities, or maybe the strategies or whatever investment you make, how far it is liquidity, how it is giving you the marketability. On the other hand, how safe it is to invest, right? What will be the return on the investment that you make, and what will be the maturity period, right? What will be the temporary investment that you have to give in, or maybe the time period. So these many things you keep in mind, and then the strategies are being framed for investing this surplus cash amount. This is said to be the fourth function. So here we are ending up with the functions of cash management as such, right? There are four types of say the functions that are being followed in the cash management, and that becomes the heart of this particular unit. As you can see it, there are advantages of cash management that has been given, and they are not new to us. In the discussion of this unit in the offline and online sessions, both the ways we have checked out with the advantages, and there are limitations of cash management also. We will quickly take the overview. What are the advantages of cash management? If a company is taking up with proper cash management, then it can have the meeting of the payment schedule, it can determine its cash balance, that means it decide its cash balance. Again, there can be proper allocation of the fund that can be done, right? You can use the funds properly, you can maintain the liquidity of the firm. Again, as we have seen in today's session itself, we can control the inflows and outflows of the cash very easily. Again, to keep the firm liquid and solvent, this cash management is a must, so that any thing is not missed out, any problem that may probe in the future is not missed out by the cash manager, right? So with the help of cash management, so many advantages can be availed. Next comes up is, you can plan and control the use of cash, right? You can control the use of cash, you can plan, you can have the future planning of the cash done in the different investment, and likewise you can make the best planning of the cash with the help of cash management. Eighth one is investing the surplus cash, not keeping it idle. Instead we are making the investment, but that can only be done with proper cash management, and if you do that, you will come to know with the proper condition of the surplus cash, and likewise we can make the arrangement. Next comes up is formulating the strategy for economizing cash. That means how we can make the economical use of the cash. Those strategies which is very important for a business to survive, those things can be easily done with the overview of the cash management that is undertaken by the managers or by the company. So in short, what we are trying to focus throughout this chapter is that it is very crucial to manage this particular current asset, that is cash, right? And if you maintain that, that becomes the kind of lubricating oil to the smooth running of the businesses. So these many advantages are there. If there are advantages, there is also the gray part, or maybe the limitations that are available for the cash management. Mind you, they are not the disadvantages, they are the limitations. So while framing the cash management policy, you can keep this limitation in mind and then you can do it. Instead, you cannot avoid the cash management to avoid not thai શકે. What we can do is we can have the limitations before us and then we can make the cash management function like that. Here, number one, contradictory in basic objective. That means to meet the cash disbursement and minimize the cash funds. Both the things cannot be done at the same time. You want to meet the cash allocation distribution also, and at that time you want to meet keep the cash funds at the minimum level also. Both these things are not possible, so you have to find out the optimum level, and that is what we saw in the previous couple of minutes, right? Next limitation is neglecting technological development, political changes, maybe only focuses of the economic recession. These things cannot be done. Instead, what we can do is at times the cash management only considers the economic recession as the main source, but you have to keep the technological development, political changes, etc., whatever the uncertainties may be there, that have to be taken in mind, and then the cash management has to be done. Means any factor we miss and we will be at the in the endangered position. The third one comes is cash flows cannot be predicted all the time exactly, right? That may be not the exact prediction of all the cash flows that can be done, and that is why a proper cash management have to take all the type of possibilities in mind, all the conditions that may be occurring in the future, that has to be predicted well, that has to be forecasted, and then if the cash management is done, then it sounds better. But every time 100% prediction will not be there or is not possible. So this constraint is always there with any of the company or business. And next is no definite solutions can be had, always related to the requirement. You cannot find out the correct requirement of the cash, and that may be the biggest constraint, right? So what happens is at times whatever the things you have, they are not enough to meet the requirement, so there cannot be a definite solution for it. But that is on the contrary, if you make the planning and if you do the cash management, this situation can be rejected, or this situation can be minimized. Again, there is no hard and fast rule for cash management, right? So certain problems which are related to it may be solved, but the rest of the problems may not be solved. Like how much cash should be set aside for unexpected challenges cannot be decided all the time, right? And that depends upon the regular day-to-day working. So no hard and fast rules are there, no formats are there, strict formats are there to follow it, and that may create the problems. Though finance manager keeping that no hard and fast rules in mind, he cannot escape this. He has to study the proper records and he has to maintain it as well, right? Again, the bankruptcy is an extreme form. So the term used bankruptcy is an extreme form here. Actually speaking, financial distresses or maybe the financial disasters is a matter of degree of shortage of liquidity. That means how far you are having the funds with you and not, that will decide your liquidity. So it does not mean the bankruptcy all the time, and this position can be improved as far as the study of from the financial manager is concerned. So every time losing the cash or maybe not maintaining the liquidity will not lead to bankruptcy. So these are some kind of limitations which are to be kept in mind, and then the financial management policies can be determined. So here we are coming an end to this particular unit, that is unit number 3, cash management, right? When we meet next, we shall be starting afresh with the 4th unit, that is management of receivables. Till we meet next, it's a goodbye from my side. Take care of yourselves. Thank you.